It was amazing. They think about upside. They think about stocks going up 26%. I'd spend my first 3 years as a credit analyst only worried about the downside and getting your money back. It was life-changing.
I think of the giant Dan Fuss at Loomis Sales, like you, experiencing both and saying the upside. Why does prosperity, in your research note, and we've others have told us this, Julian Emanuel this morning, 22% of companies reported, 84% beat consensus. I mean, it's a popping quarter. What does it mean for Intel bonds?
So I think for bonds in general, so great question. For starters, as you said, we don't, yes, you may. We don't really care about earnings per share. We care about revenues and profit margins and ultimately cash flow. What you've seen broadly in earnings this year or this quarter so far is top line revenue growth is up 7% and margins are quite solid. So that typically translates well into cash flow growth, which is good for bonds.
There's been a tremendous amount of new issuance. I wish I was back in my day on the debt capital markets desk. I mean, talk to us about the deal flow. What's it telling you about the marketplace here today? Where are you guys finding value?
Another great question all the way around. So let's talk about the corporate credit issuance.
Yeah.
We've had really, I think, record issuance in the investment grade corporate bond market. And, first off, overall demand is more than 4 times, and new issue concessions have dropped down to 2.4 basis points.
Really?
So you're right. There is a tremendous amount of supply, but that supply has been very well received. Similarly, in the high yield corporate bond market, there's been $30 billion of new supply issued year to date in high yield. Those deals have also been well digested. The one exception that I'm going to note, and there was a headline in today's Wall Street Journal about this, the one exception is there's been a lot of demand. You ask about Intel, there's tremendous demand as we navigate this new period of artificial intelligence, demand for data centers, demand for chips, demand for power. And so there's been, in the high yield market, there's been, I think, $35 billion of issuance that's data center related. Some of those new deals have actually not performed as well.
Really?
I think there's, in high yield, that type of supply has gone from zero AI, hyperscaler, data center related. It's gone from 0% of the benchmark to about 2%. So maybe we're starting to see some rotation from prior deals into new ones.
There's some market moving news here. I'm going to have to interrupt, Kara. This is brilliant. First of all, there will be a press conference in 53 minutes from the Pentagon. That is out moments ago. I assume that is the Secretary of Defense, Chairman of the Joint Chiefs of Staff, the Admiral of the Navy, Admiral Cooper, appearing next time. And here are two always distressing headlines. This is the Israeli Prime Minister, Mr. Netanyahu, says he has had treatment to remove a tumor. This underwent treatment for early stage prostate. Okay. Never like to see that. I mean, that's just very difficult. Let me see if I look at it. Paul Sweeney taught me how to look at these screens as well. No, we just have the two headlines right now. Underwent treatment for early stage prostate tumor. And we'll continue here with Kay Herr of JPMorgan. Paul Sweeney.
Kay, we're kind of in the teeth of the earnings period right now. I mean, how does the credit market view the quality of earnings coming out of corporate America these days?
So far, it's been solid. I mean, the point is a good one in that earnings, you start with the top line. And as I said, we've seen revenue growth of about 7%. So that's quite solid. On the EPS side, so you've got revenue growth. We've actually had a bit of margin expansion, although there's some dispersion in margin expansion, but most sectors are still expanding margins. And then there's also been share buybacks, et cetera, which not only do we not care about, we'd actually prefer not to see. But overall cash flow has been solid.
You were the single best person for this question. I've asked it a couple times, and I've got sort of...
I just got asked about the Mets, so you're making me nervous. I'm not an expert in baseball.
No, this is not baseball at all. And that is with your equity fixed income experience for JPMorgan. If they issue bonds, all these tech companies that have 1%, 2%, 3% bond exposure, what is the equity impact or equity effect of a mega $billion bond issuance for a hyperscaler? I think the media tends to compartmentalize. Merton Modigliani was saying, no, don't do that. What portion of that oomph of issuance, as Paul mentions, is an equity-related oomph?
So if you think about it, broadly, there's two types of issuance that we've seen in the debt markets. The first is the actual hyperscalers, and they range from AA rated credits to lower BBB rated credits. So they're kind of pricing debt in the 5.5% to 7% range. So that goes on balance sheet, and it's interest expense, which is going to come out of profitability. But the fact that companies can raise debt for the next 30 years, 15, 20, 30 years at 5.5% gives them some certainty that they will have the capital to do these capital expenditures, to buy the chips, to finance things. The other piece of the financing that we are increasingly seeing is financing for the actual data centers, and those are structured more like triple net leases. So those are more like project finance. So exactly. I thought you of all people would appreciate that.
God,
those, some people might think that on the equity side, they might think that's free money. So some of those are not going to be recourse. Now, there've been, I don't know, maybe half a dozen to 10 deals. There's a broad range of different terms in those of whether they are guaranteed or recourse or not.
Right.
So the short answer to your question, Tom, is it depends.